We have that oil trade from before where we were shorting at 70, and that's still on. We're going to leave that because it should have a much better rejection than we're looking at there. Well, let's talk about that. So what made us short the oil? We wanted to short the oil because it ran up to 70. 70 is a serious resistance point. It even went a little bit higher right into the report, but hang on. Let's get into the nuts and bolts of it. Most of the time when we short a commodity, we don't do it. We look to short a commodity, we don't do it because the conditions have to be just right. And so what happened today, and this is what time was this? Oh, I'm sorry, this is the Morning Post. So in the Morning Post, no, that was an old thing. Sorry, that was an old thing I said. Nope, not that one. That one. So at 10:37, right after the oil report, we had already looked at API driving the market higher. And I guess I should find that first. So Control F, API. So the API oil report came out last night. And no, that's not, gotta check that more carefully before I start talking. Okay, so here's the API oil report. So I said energy is popping. This was this is 9:52. So this is before the EIA report at 9:52 a.m. I was saying to the members in the chat room, I said energy is popping, of course, as oil bumps back to 70 after headline 4.6 million barrel draw in crude on the API report, and a 3.3 million barrel draw in gasoline and a 1.3 million barrel draw in distillate. So it's 4.6 plus 3.3 is 7.9, 8.9, 9.2. So there's a 9.2 million barrel draw being shown on that report. I'm not sure what this window is going to show me. Oh, here you go. So this chart doesn't reflect it, but 9.2 is way the frick down here. It's a massive draw. It's as big as our biggest build in February. So here we're saying, why is oil running back to 70? Now don't forget, this is 9:52. And so at 9:52, see on the bottom of the numbers? So this is what I'm saying at 9:52 as we're heading towards 70. All right. So we're watching it, and I'm saying, look, the API is showing a big draw, but the API isn't 100% reliable. You have to understand what makes up why things are happening and what makes them up, so that you can figure out whether or not you should make a counter move or not. So the API, which came out last night, right? So let's say around here, caused oil to pop, and it kept going up. And here, look, the big surge at 9 o'clock at 9 in the morning, basically. There was a big surge pushing oil up towards 70. And we know that that's because it's ahead of the API, which comes out at 10:30, which is right, the EIA, sorry. The EIA comes out at 10:30. And so I was expecting, because 9 is such a big number, I was expecting that the EIA report would not show as strong of a draw as the API report. Another thing to understand about the API report is the API report is based on a survey of oil warehouses, and they don't do a count all the time. Basically, they eyeball their warehouses. They're looking at the data and so on and so forth, but they're not doing an accurate count. And so the API is really a survey, and the managers will sometimes say about this, about that. They're not exactly accurate with the API. The EIA is more accurate because they're measuring tanks and so on and so forth with inspectors. So they're going to give you different results, and it's a sampling. The EIA is more of like, this is how much there is, whereas the API is a sampling. So they don't match up. There's a little bit of exaggeration sometimes with the API, because you're polling oil people who want the price of oil to go up, so they might exaggerate that there's less oil than there is. You know, you can call it what you want. It's basic manipulation, but it is what it is. So I was a little skeptical, and 70 is a good resistance point, and there's not enough hard evidence to show that oil should be right over, not that oil should absolutely be over 70. So given all that, I said, well, probably will be rejected at 70. Now, how much are we going to be rejected at 70? That goes back to the concept of the balance chart, right? But one thing at a time. So we expect to get rejected on 70. We popped over it a bit, but we had a chance, multiple chances to get back in on a short. And here we are on a short at 70. And we are now getting a little bit of a pullback. 20 cents is good money, though. It's $200 per contract. There's 4 contracts short here. And that's the mechanics of it. You want to be, you know, usually when we're looking at a setup for commodities trading, most of the time we look at it and say, oh, no, I can't be sure enough. I don't have enough evidence. It's not worth playing. You shouldn't play when it's a coin flip. You should play when you have pretty overwhelming evidence that it's going to be right. And even if you're wrong, even if we're wrong, this is a very tough mark to beat. This is what you call a standard deviation. That's one standard deviation off the norm, 2 standard deviations off the norm. And this chart is called pivot points, by the way. So if you're in Thinkorswim, you want to do a study, and you add a study, and the study is a trend study under P. And that study is called pivot points. That's how you find it. So in other words, what I'm doing is I'm right clicking on the chart. I'm going down to studies. I am adding a study. I am going to a trend study under P, and that is pivot points. That's what this study is. And the pivot points means that this is where the median is for this. This is where the trading median is for the day. And this would be 1 standard deviation above, 1 deviation below, 2 above, 2 below. Things rarely go more than 2 standard deviations off. So when you see something hitting that 2nd standard deviation, see over here too, that's a good reason to be shorted. Now, on the danger side, when something blows below 2 standard deviations, that means something got very weak. And the NASDAQ and the S&P both got very weak. Why did that happen? Because Trump came back with the tariffs. But let's have that conversation after we delve into oil. So in other words, the danger of a loss here was kind of limited to this, which would be a $300 loss. But the danger of a loss here was kind of limited by this red line, and then I would, you know, strongly expect the red line would be rejected. So I was pretty brave going into it and saying, yeah, we expect to, you know, we expect this thing to go short at 70. Now, when you're watching it now, what are we getting? We're going to get a bounce off of this because it's another. Now it becomes a support line on the way down. So standard deviation 1 becomes a support line. But in this case, as we look at the EIA data, well, we're not even there yet, but as we look at the EIA data, it did come in weaker than the API data. So this is 950, I think it was, right? So this is 950. This is very funny if you're a Star Trek fan. And then at 1037, I said the EIA had the same kind of headline draw on oil, 3.3 million, but not the same on gasoline. Gasoline was only down 1 million, and distillates were only down 400,000. So that's 3.3, 4.7, 5.1. So 5.1 versus 9 on API is a huge difference. Much, much less of a draw here. That's going to disappoint the oil bulls and cause oil to pull back. So now let's talk about how much it pulls back. So that brings us to the 5% rule. And we're going to apply that to the oil. And we're going to look at WTIC. And we'll go to the 5-minute. So what happened? API came out last night. It indicated a big draw. In the morning when Europe wakes up, it starts going up. We start trading up, and we trade all the way up from $69 to $70. Okay, but then that's a huge move. That's a $1 move. So, or really, I would call this support because it had a consolidation. So I would call that support to say 69.20. So we went from 69.20 to I would say 70. I would call this a spike that we're going to ignore, not a consolidation. So we went from 69.20 to 69 to 70 is 80 cents. And that means that the pullbacks are going to be 20% of the run. So again, you ignore these because these are spikes. Don't forget these are 5-minute charts. This spike up, spike down. If you look at it in an hour, okay, see on the hourly chart, that's what it looks like. Just that one little spike up is all that it looks like. And that's exactly what we would throw out. So you have to be aware when you're looking at close-up charts that something like this is just a little spike that wouldn't even count. So we spike up, we spike down, we spike up, we spike down. We're still going around this, but still hugging the 70 line. And now you see it finally, it becomes resistance on this third attempt, and now it's giving up and going back down. How far is it supposed to go down? Well, like I said, we went from 69.20 to 70. That's an 80-cent move up, and that means it's going to be 20% of 80 is going to be your bounce lines. So what you have here is 16 cents below 70, which is 69.82, right? No, 84, 69.84, sorry. 69.84 then becomes your a week retrace. All right, so you can see how that line's behaving. That's your week retrace line. The next line then is another, oh, I'm sorry, 16 cents down. Another 16% would be 78, and minus 10 is 68. So the strong retrace line is going to be at 68. Now you see how 68 was significant on this side too. All right, so that's going to be a serious point of support because it was a point where we broke out before. So we can expect that to be pretty strong. And by the way, if you want to know how much you can expect to bounce off of that, you would do the exact same thing. You go 70 to 68 is 32 cents, and then 20% of that would be 6.4 cents. And that means that a weak bounce there would be 6.4 cents higher than 68. And a strong bounce there would be basically 13 cents higher than 68, would be the strong bounce back. So the rule applies over and over again. You can layer it in. So it's first we're going to fall back to the strong retrace line, then we're going to bounce from there. And now if you're betting on the oil, you might want to say, well, you know what? This is $320. When I get down to 68, that's $320, and then I'm almost positive it's going to bounce back from there at least 6.5 and probably 13 cents. So do I want to ride out that bounce? That 13 cents is going to wipe out half the money I made on the way down, and I don't know for sure that it's going to come back again. So yeah, that's a good place to take some profits, is when you hit your goal at 69.68, unless it goes right through it, you might want to say, oh, I should take some profit off the table at that point. Now, if that fails, the next support is going to be the strong bounce line, and that's a strong bounce off the bottom. But the strong bounce line will be another 16 points down at 52. And then you always want to look on the chart and say, well, does that make sense? Now, you notice I'm pointing my finger. I can't really, because if I move the thing, it keeps getting off kilter. But on the left of the T, right, of the left of the plus sign there, you can see how 52 was a series. See how it was resistance? At 6 a.m., it was resistance on the way up, and it was resistance on the way down. Later, at like 9 o'clock, it was resistance on the way down. So that's showing you, when you see that, that shows you that the 5% rule was actually working the whole time. So we could have predicted all this movement, you know, had we calculated it in advance, saying this is what would happen if oil gets strong, we could have predicted this entire thing yesterday. We had the same numbers. Now, failing that line, that's a strong bounce line. And if we go below the strong bounce line, we get to the weak bounce line, which is 18 cents below that. So that'd be 44.34. So 34 is the next line. And that, oh, isn't that funny how if you go further back here, the 34 line was significant on the way up over this way. So wait, 33, 35, 34. So the 34 line was significant in this area when it was consolidating. So that was the weak bounce line. The weak bounce line where? The weak bounce line off 69.20. And then obviously below that is going to be 69.20. So where were we? Okay, so 69.20. Now, usually oil moves in dollars, so 69 should have been significant, not 69.20, but that's just the way it worked out in the very short term. Okay, if we were looking at the hourly chart, we wouldn't give a shit about any of this stuff. In the hourly chart, we're looking at 67.50. The run was from 67.50, where we had good consolidation all the way over here. So the run was from 67.50 to 70. And that run gives you $2.50. And if you take 20% of that, it's 50 cents. So every 50 cents here is significant. And that means we would expect a week retrace to be 69.50. So that's encouraging. As a short at 70, that's very encouraging, because in the bigger picture, we would expect to see 69.50 tested, and that's going to be a $500 move down for us. So we're thrilled about that. So given that we had this nice possible, and of course, if that breaks, then you're down to 69 and we make $1,000 a contract. So given we had such a good setup where the risk was not that bad, we very much doubted it was going to go over 70-20, I think, or 70-30. The risk was low and the reward potential is high, and the facts are very much in our favor. Therefore, we make a trade. If we don't have all that stuff lining up, though, we shouldn't make the trade. You know, because futures trades are really, really random. It's like very, very hard to predict. So if you don't have overwhelming information in your favor, if the technicals and the fundamentals aren't lining up to give you a very high chance of winning, don't play. So we had what's the short story? We have an 80 cents ride for the day, right? That was our 5-minute chart too. We're looking at the 80-cent ride for the day. From 69.20 to 70, that's your plus 80. So for the day, what happened? Well, what happened is the API report said 9 million, but the EIA said 5 million. 5 million is still a draw. So I'm not going to really expect to retrace more than half of where we were, because it's still a draw. It's not that there wasn't a draw. There was a draw, and that's what it looked like. So we'll see what happens. All right, so what did we say the bounce is? Now you get back to that. So the bounce from 70 to 69.20 is a 20-cent drop. So we're looking at a 4-cent bounce, which is right here is a weak bounce. We're hoping the weak bounce is going to fail. If the weak bounce doesn't fail, we really have to consider giving up, and we have to give up if it goes back over 88. Over 88, we still make some money, not much, but at least we make some money and we can walk away with dignity. But right now, 84 is the weak bounce, and what we're hoping is that 84 fails. All right, so that's how that's the kind of detail you have to go into to play a commodity short. And very important though, it's like not even 9 out of 10 times, it's really like 95% of the time. So 95 out of 100 times, when you look at a setup, you don't play. Oh, I'm sorry. That's not a good way to put it, because if I say that, I know people sit there and stare at the screens and you're looking 100 times a day at the screen. No, that doesn't mean you play 5 times a day. I'm talking about looking once a day at my commodity setups in the morning and saying, no, thank you, no, thank you, no, thank you, no, thank you. And once a month, twice a month, and the members know this, once, twice a month, we'll make a commodity play using the futures, but not every day, and certainly not even every week. It's got to be a good time to play. We have to have good reasons to play. And especially when you're in these crazy volatile markets, you should really be erring more on the side of caution, because who knows what the hell is going to happen between the time you go to the bathroom and come back. I mean, it's absolutely insane. And it just happened to me when I went to grab something to eat earlier, and the market's reversed because frickin' Trump says under the tax, we're going to do the auto tariff sooner than later. And everybody went nuts. Speaking of which, how the index is doing. So I'm going to ignore this for now. Hopefully it doesn't burn us. So here's, oh, that's so awful. So here's what happened to the indexes. We were having such a nice morning for a while. We were up at 43.1. Now we're at 42.8. So that's a 300-point drop in the not a very long amount of time. What is this? Oh, that's hours. Yeah, so from here, we're down to here. So that's 300 points, this drop. And it happened right here. It started at 11:10, which is right about when I went to go make myself some salad. And then I started eating my salad. And then by the time I sat back down at my desk, I was like, what the hell? What are you going to do? I mean, this is the insanity of the policy. And what did I say about that when it was time? Yeah, so my note was, things turn ugly. Why do they turn ugly? Trump prepares auto tariff announcement as soon as Wednesday. We are, well, Hunter picks up on this, so let's let him talk. So there's that. I said, like I said, it's ridiculous when they just rumor the market up and down. The Magnificent Seven fell apart on tariff angst. U.S. faces pain. This is all in one day. This is not how a day is supposed to be in the market. This is how you look back in history and say, oh, yes, in the spring of 2025, this is what happened. Not Wednesday. This is what happened Wednesday morning, all these changes. So U.S. faces payment default risk in August from the CB. This is, Congressional Budget Office. This isn't like some random guy. So U.S. faces payment default risk in August and September, according to the Congressional Budget Office. Trump insists the U.S. must own Greenland as Vance heads there. I mean, come on. So I said every effing day, it's just so much insanity. And I asked Hunter to follow up on that. So what he does is he reads what I'm saying, and then he says what he wants to say. So Hunter says, okay, this is the point. What we're witnessing here isn't just unusual, it's historically unprecedented in both pace and scale. The average tariff rate under Trump is projected to hit 8.4%, 8.4% added to the goods and services that we import. 8.4%, that's the most since 1946, the most since just after the war. That was 80 years ago. Let that sink in. We're reverting to a post-World War II protectionism. When previous administrations, this is the other very good point he makes, when previous administrations made significant economic policy shifts, they typically unfolded them over months or years. So when you hear these guys from the government on TV saying, oh yeah, Harding did this, or Hoover did that, or McKinley did this, they did it over years, not on Wednesday morning. They proposed a tariff, they discussed it with Congress, they talked about it with business leaders, they did studies. They didn't fire the people who do studies, they did the studies with the people who do the studies. And they figured out, and they made horse trading in Congress like you're supposed to do, to say this will be too much for this guy and that'll be too much for that guy, and this has got, this we need to do for this industry. There's none of that. This is just blanket, just throw shit to the wall and see what sticks. Reagan's tax reforms, even Obama and Obama's stimulus package. I mean, how much fighting was there about every single inch of those packages? That's the problem, though. See, when you think back on it, it's like a little line in the history book that says, Nixon took us off the money the money system. Yeah, he did it, but it was like years of planning. Like Brexit was, right? We just saw Brexit. That was a major international decision, but it played out over the course of years, not a week. It wasn't like the freaking Prime Minister of England woke up and said, "Hey, let's get out of the EU," and then that's on Friday, and then on Monday they're like, "Okay, we're out of the EU now, bye." It doesn't work like that. They had to disentangle themselves for years. What we're doing, it's not ripping the Band-Aid off; it's ripping the arm off that had the Band-Aid on it to see, and then see what happens. There's nothing gentle about this, and it's not being done correctly. And anybody who understands economics will tell you this is a terrible way to conduct policy. So the markets praise stability and predictability. The administration does not deliver that. That's what the problem is right now. It's tariffs or no tariffs isn't the point. It's that you don't know what the frick is going to happen next week. They, for a month, they've been saying that they're going to do tariffs on April 4th, but we thought at some point during the time between February 4th and April 4th, when did they discuss the thing? Yeah, well, whatever. Between the last ones that were delayed, I can't even remember what's going on anymore. Between the deadline of the last time and now, we kind of expected that they would actually put a plan together so that you would know what's being tariffed. So that they would say, here is our plan. This is what will be happening. These are the amounts that we are tariffing things, so that companies can plan their expenses and changes of numbers and so on and so forth. None of that happened. They're still just changing their mind on a daily basis about what will and won't be tariffed. So tariff uncertainty disrupts predictability, making it difficult for firms to forecast corporate earnings, supply chain costs, global market demand, and it makes it hard for us as investors to invest in those firms. Companies can't plan beyond next Tuesday's tweet storm. They freeze hiring and investment, and it screws everybody up. And Trump's tariffs are projected to reduce GDP by 0.4%, eliminate 309,000 jobs. After-tax incomes are expected to decrease by an average of 1%. The recent market sell-off reduced, well, that's already happened, so that's too late. We already lost our market gains. And where we're heading next. Companies pass on costs to the consumers, inflation ticks up, spending drops, and we spiral into a completely self-inflicted recession. Policy whiplash, Trump, or which we have no idea, or Trump does what he did last time, which is just say, "Oh, forget it," or we'll put it off till July now, whatever. And then the market, and then we rally back. But he makes a good point that then the capital is misallocated, and that's in fact like we're doing now, like yesterday or last whatever day it was. Last week we put money into our long positions in the portfolio reviews, and then this week we added 15 different. I took 15 different plays in the top trade alert we just did. These were, we were adding back things that we already had in the long-term portfolio. We haven't gone to new stuff yet. We only added back things we were already playing in the long-term portfolio. Why? Because we worried that we might miss a big bounce, right? We don't want to miss a big rally. So here's a bounce. We don't want to miss this part of the bounce. We don't want to miss going back. I don't really deep in my bones think we're going back, but the stocks we bought were nice and cheap and so on and so forth. So what I'm hoping is that we do a W here. Do we have an example of a W? This kind of is a W. So I'm hoping we have this, which is that we come down, we bounce up, we come back down, we hold it, and we go back up. And that's what happened here. And here also. But this, see, you don't want to, this is tough because this W makes it look like you're going even lower. But the point is, you come down, you have a little correction, you come back down, finish your correction, and then start. Now you've gotten enough of the weak buyers out, where the buyers who are willing to buy and hold step in, and the market goes back to normal and starts climbing. And climbing is the normal thing the market does, because in theory, economies expand and earnings expand and so on and so forth. And even in inflation, earnings expand and economies expand. It's only if you have deflation or stagflation that you don't expand. And unfortunately, we could be heading into stagflation. So that's a W pattern, and you get a lot of those. Is a bullish pullback. Here's the W pattern too. See here? We go down, we go up, we go down, and we start climbing again. Then another broken W, that's scary, and then you come back up, and then you go down. Now you have a bullish W going that way. It's a lot of those kind of patterns you see. And so we're hoping that we do this and this. Now, the question is, how much damage are the tariffs? We know about them. We've known about them since November when we elected Trump. We knew it was going to happen. So hopefully we aren't, gaining 10% after electing Trump and knowing he's going to do tariffs, that was stupid. All right? That's too much. Coming back down, getting back down to like the 4,000 level, that's fine. And we don't mind holding our stocks at 4,000 because we're going to, sell puts and calls against them and make lots of money. We're just worried about 4,000 not holding. That's what we're really worried about. Oh, I'm sorry, not on the Dow. Frick the Dow. It's like, why are we looking at the Dow? We should be looking at the S&P. I'm sorry, I apologize for that. So here we were at 5,700 basically. We went up to 6,150. We came back to 5,600. We're making our little W. Hopefully 56 holds, but if it doesn't hold 54, we kind of have faith in 54. That seems pretty reasonable. 52, I think, is getting a little low. 5,000, I'd be very surprised if we can't hold 5,000. But 5,000 is a 20% correction from 6,000, or from 62 anyway. So 5,000 would be a serious correction, but that's what we've been hedging for the whole time. We've been hedging for a 20% correction. So what we've done is redeploy some of our long capital. We still have a ton of cash. We still have a ton of hedges. But we redeployed some of our cash back into long positions, but they're the kind of long positions that we don't mind putting even more money into if the stock market drops another 20%. We're prepared for that. We're going to make a fortune in our short-term portfolio if the market drops 20%. If it doesn't, then we're good. Our fear then, because we have no fear of a big drop, we make money, we make a huge amount of money in with the short-term portfolio. So our short-term portfolio, May of 23, we started with $200,000. We're now at $1.3 million. So we're up $1.1 million in profit in our short-term portfolio. We have $332,000 in cash remaining. So I'm looking to raise cash in the short-term portfolio, not spend any more, because that's an uncomfortably low amount of cash. So we'd like to raise cash, but I'm happy with the hedges we have right now, and they're obviously paying off very well, because when we did our last portfolio review, we were probably 200,000 lower than that a couple of weeks ago. So it's holding up very well for us, and we're going to look to somehow take some money off the table. I'm not sure how exactly yet. But we're gonna want to figure out a way to cash something out and bring that back up to like $500,000 if we can. Oh, and this isn't reflected here, but we also added we did put some cash in, because we added we sold a bunch of short puts. We sold about almost $100,000 worth of short puts. And again, That's in case the market goes up, it'll pay for us to adjust our short positions. And then long-term portfolio has not taken significant damage. And again, we haven't added in the new positions back yet, not reflected here. But now the long-term portfolio is up to over $4 million. So that's in really good shape as well. And we're just firing ahead. So we're good with this stuff. How's the 700 a month portfolio looking? Let's see. 104%, very good. Very, very good. Okay. So, so our portfolios, our long portfolios are just moving along just fine. And what we want to do, oh yeah, we're going to talk about the money talk portfolio. So it's all about balance. And this is flat, and we added 4 new positions to this yesterday. Oh, that's what I want to talk about, those positions. So, we're pretty well balanced. We wrote out, this is untouched from 3 months ago. We had a good diverse, we got AT&T, we got Barclays, we got Barrett Gold, Invesco, Lockheed Martin, which has been the bad boy of the portfolio. We have Nokia, we have Pfizer, we have Synchrony Bank, which was our trade of the year, also not performing for us so far. We have Target and we have Exxon. So it's very diverse, and all stocks that we certainly don't mind buying more of if things keep going. Oh, I'm sorry. So we're still reading this. I forgot about that. So Trump could back off the tariffs, and then we're going to go flying up. This is what we're worried about. We're prepared for Trump's tariffs. We're prepared for 10% more damage on the downside. We're not prepared, or we were not adequately prepared for a big pop up, and now we are. So now we added a bunch of positions back into our portfolios, and now we feel good no matter which way the thing goes. The transition phase purgatory. The administration frames economic pain as necessary. Oh, it's that transitory thing that Powell's been saying, which is bullshit. How is it transitory? If you put a tariff on, and it's a 10% tariff on imported cars, right? Or let's say whiskey. Let's say you're buying a bottle of bourbon, and it's usually $50, but now there's a 25% import tax, so that's $12.50. So now it's $62.50. What's transitory about that if they don't remove the tariff? How is that transitory? It's not transitory. It's $62.50. You know what the Fed says though? The Fed says, well, sure, it's $62.50 and that's up 25%. But next year, it'll still be $62.50, and we're going to say that inflation is 0. And that's bullshit. That's not what transitory means. Unless your wages caught up and you got a 25% pop in wages, the $62.50 you're paying is inflation that's stuck. And this is, and by the way, the reason they do these definitions is so that they can screw all the people getting Social Security, because they say, oh, you don't need a Social Security increase because the 25% increase in a bottle of bourbon that you experienced last year, and you got a cost of living adjustment of 5%. Now the bourbon is still $62.50, but it's the same as last year, 0%. So there's no need to adjust your cost of living, because the whiskey didn't get any more expensive. And the problem is, the reality is, for the person who was buying the whiskey, is I can't afford the whiskey anymore. So I've cut it out of my purchases, and now I can't, and now I'm not going to be catching up, because you tell me that your bullshit increase last year was the only one I got because I'm no longer experiencing inflation. The only time you're not experiencing inflation, the only time inflation is transitory, is when your wages catch up and your buying power resumes at the previous level. But they're not going to tell you that, because that would mean they would have to adjust your Social Security up to double, I would say. I'm not going to look it up now, but I say that they believe me, you can see it in charts that it's the same thing as the minimum wage. The minimum wage is falling so far behind the cost of living that it's a joke. You can't make it up. How can you make it up? How can you get people back to what they would call a living wage? And you can't when you fall this far behind. And then they say, oh, well, it's unrealistic to raise wages that much. That's because you've been screwing these people for 50 years. It's when you screw people for 50 freaking years in a row, it's kind of hard to unscrew them in 2 months. And that's the flaw in the plan. And then these Republicans get on TV and they say, oh, well, this is unrealistic and we couldn't possibly do that and it would be terrible. Same thing with the corporations and the wealthy people who have not paid adequate amounts of taxes since Reagan, since the 80s. So for 40 years. After 40 years of being undertaxed, yeah, it's kind of hard to make up the $36 trillion deficit tomorrow based on taxing the wealthy, because but they're wealthy because they've been undertaxed for 40 years. That's why they're wealthy, or that's why they're that wealthy. So as I point, well, okay, let's one thing at a time. So, oh yeah, and then we're also pretending that everything we're doing is in a vacuum, because if we get retaliatory measures from China, Mexico, Canada, the EU, blah, 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 if they retaliate, then there's even more stuff that goes up, and all these estimates from the Congressional Budget Office become extremely conservative because they didn't take into account the fact that we don't raise tariffs and then everybody else just sits here and takes it. They will raise tariffs to us. Canada just took away, they have a $7,500 per car EV tax credit when you buy electric vehicles. Like I don't know if we still have it or not. I don't know what the hell is going on in America, but Canada had it, which was the same as the $7,500 credit we had in America last year under Biden. And now they're saying except Tesla, which is a big FU to Elon Musk. And that's a retaliatory tariff. Right now, Tesla is $7,500 more than other cars in Canada because Canada is striking back. And that's because Musk has tied himself into the administration. So this isn't normal market turbulence, it's manufactured chaos, masquerading as economic strategy when historical perspective shows you economic policy is most similar to the immediate aftermath of World War II. You might want to reconsider your approach. So strapping, keep your powder dry, blah, blah, blah. Okay, whatever. Now, what were we talking about? I forgot. I was going to look at something. I forgot what it was now. Oh, I was going to talk about what I was showing in earlier in the day. So in this morning's post, which started out talking about, what did we start out talking about? Copper. We talked about copper, and again, tariffs and higher prices and the effect on copper, which is going to hit a lot of different things. But these are the same things that Bodie analyzed a long time ago. Back in January, here was a demand premise for copper that EVs use 3 times more copper than regular vehicles. The EV sector is going to grow, and Trump's not stopping this. It might stop in America, but there's a whole world out there. We sell 16 million cars in this country. There's 100 million cars sold around the world. So if we decide that we're not now, and not only that though, but only 10% of the cars sold in America are EVs. So we're selling 1.6 million EVs. The rest of the world buys a ton of EVs. So when we decide that we're not going to make electric cars, we want gas cars and we're going to keep driving our gas cars because we're Americans, blah, blah, blah. So when we decide that unilaterally, the rest of the world doesn't give a shit. The same way we drive big cars in America and the rest of the world drives little cars. Why do they drive little cars? Well, because they weigh less and they have better mileage. So the rest of the world already has smaller cars and doesn't drive SUVs and trucks everywhere they go. They drive normal small cars like Mini Coopers and things like that. That's a normal car in Europe. because it just makes more sense. There's no need for what we drive. We drive insanely large cars, and we're using so much more fuel than we need to. But anyway, point being that we make our American cars, and then we complain that people around the world aren't buying our American cars because they're too freaking big. They're not practical in the rest of the world. That's why people don't buy our cars. They would buy our cars if we would make the kind of cars that people like to buy in other parts of the world. So just because we decide we're not supporting electric cars anymore, it doesn't affect the world market for electric cars. So around the world, the EV sector is growing at 14.3%. Transportation sector is sucking up copper, going from 11% to 20%, doubling their copper demand. And data centers are going from 2% to 9%. I don't know what the number is. It's up 300% is what that is. Digital copper demand, 6-fold increase over there. Copper demand split, energy transit, whatever that is. So more and more and more. So more and more and more copper between data centers causing energy demand and electric cars having the energy demand, and then the actual vehicle itself and all the battery storage units and so on and so forth. It's copper, 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 copper everywhere. So this is, this is all back from January something when we did this, January 7th. So on January 7th in the chat room, this is what we were talking about. And then so we decided that Freeport would be good, and obviously, so from January 7th, it went down and now back up. TGB also went down a bit and now back up. And Southern Copper also from January down. They all did the same thing. Basically, they all did the same thing. So on top of this, you're adding now import duties on copper, and of course prices are going to go nuts. They were going to go nuts anyway. So Bodie said copper would reach 10,400 per ton by late 2025. It's already over. It's at 10.8 this morning. So this was a very good prediction, especially when you consider that copper's up 30. Copper had to climb 30% to get to this number from where we were at the time in January. And then on November 18th, we had this trade on U.S. copper index because it wasn't a new story. We were following this, and here's what happened. So in November, when was it? November 18th. So back on November 18th, which is here, we put out the long on the copper index, and it was the same thing. It was the same premise, basically. We were like, this is going to be a big thing for 2025. And then what is this? January 2nd, we talked about, then again, like I said, the commodity play. Here's where we talked about like actually being long on the copper commodity itself based on the weaker dollar and the demand for copper. I mean, it's been a theme we've been following all year. And that's been a huge increase. We played gold. Oh, then I was going to say the household wealth thing. What I was saying about not being taxed, right? So household wealth is not the same as household income. Household wealth is how much are you worth if you liquidate everything. So the bottom 50% have 4,000 billion, $4 trillion. That's the bottom half of the country has $4 trillion total. The rest of the country has, let's call that 60, 110, and let's call this 50 more. No, it's not 50 more, it's 45 more. So 110 plus 45, 155. So this is roughly 155 billion versus 4 billion. That's the difference. This is 97% of the wealth is held by the people above the bottom 50%, the top half of the country. They have 2.5% of the wealth, $4 trillion. It's 48 trillion, 58 trillion, 27 trillion, 22 trillion. So the one point I made was, look, if you want to fix this, and again, don't forget, this is 40 years of undertaxing the top 1%. All these guys, in fact, these guys, the guys who had 49 trillion, $50 trillion, the reason they have that much money, and these guys too, I mean, frankly, it's, you know, even the top 10%, but these guys especially, the people who have at least 10 million, 20, at least about $20 million of household wealth, minimum. So if you don't have 20 million liquid, it's not you. But the people who have 20 million plus of household wealth, and this group has 160 million on the average of household wealth, okay, they've been undertaxed. And that's we, I shouldn't say they, it's we. We've been undertaxed. Most of you guys are somewhere in the neighborhood, right? So we've been undertaxed for many, many years. We used to pay 65, 70%. Before Reagan, the top tax rates were 70%. And corporations paid it and people paid it and whatever. Now, since then, we went to 35%, basically half. And you know what happened? That caused every single year for there to be $1 trillion deficit because we stopped taxing and we in no way, shape, or form made it up. So we just simply stopped taking money in taxes from the top 10%. We took half as much as we used to, and that includes corporations too. And had we not done that, we would have no deficit. Had we not taken $1 trillion a year from the top 1%, we would have no deficit. And this country would be unbelievably healthy and strong. Instead, we are 36, 37 trillion dollars in debt. And these guys, and it doesn't even translate all the way over. That's the sad thing about it is it doesn't translate that well because all that happened is these guys accumulate 22 trillion. These guys had 27 trillion. It's 50 trillion. So basically all the money just, you know, the deficit is incurred upon the whole country so these guys can get $30 trillion richer. And you can see that. Where's that other chart? Here we are. Here's Reagan, right? These two guys, the yellow is the 1% and the green is the top 1%, the 0.1%. So they had $5 trillion. Okay, and now they have what's that? 110 to 160. Now they have, well, 50. Obviously, they have $50 trillion. So they've got 10 times. They went from 5 to 50 trillion. How did they go from 5 to 50 trillion? By paying less taxes for the most part. And the next set, the rest of the 10% also again benefiting from paying much less taxes. They went from 10 trillion to 50, and that's 1 in 10, so that's $60 trillion. And again, we could look up here. Yeah, $60 trillion, right? So they went from 10 to $60 trillion. So they went up 5 times. These guys went up 10 times. The rest of the top 10% went up 5 times. The bottom 50% went from 10 trillion to 50 trillion. They went up 5 times also. So the top 10%, the top 10% less 1%, that's the 9%, whatever you call it, they went up 5 times. These guys went up 5 times. These guys went up 10 times. And that 10 times is our national debt. If they had gone up 5 times instead of 10 times, it would be half as much. And that would be instead of 110, instead of 50, it'd be 25. So it'd be 25 trillion hard money less that they would have, and everybody would still be in a normal proportion. It wouldn't hurt. It only hurts when you have to give it back all at once. If they had had it the whole way along and they grew slowly with everybody else, it wouldn't be a problem. But now they're saying, hey, that's our $50 trillion. So, and I said, you know, you have to realize it's so disproportionate that these guys have $60,000 per household on the average. And by the way, that's lumping the bottom 50%. If you go to the bottom 20%, they have nothing. They have zero, 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 zero. You know, you got to realize that they have absolutely nothing. They live day to day with no assets. You know, it's really, you know, a step above shopping cart people. And you know, it's, you know, our kids we went through this phase, or most of us went through this phase in college, and our kids go through it in college. They have nothing. They have no money, no assets, no nothing. If you tell them they got to leave their house, they go, oh, okay, and they put all their stuff in the car and they leave because they don't actually have anything. That's no wealth. That's no wealth, no assets. If they got a car, that's an asset. They're better off than most. But the point is that if you want to fix this, all you got to do is tax these guys 20%, take 20% of their money. They're not even touching this money. Take 20% of their money, or 10% of their money. 10% of this is what? 29, 49. So 10% of this is $10 trillion. No, I'm sorry, not 10%. 20% is $10 trillion. So you could take 10% of the top 1%'s money, and that would double their wealth. That would more than double their wealth. If you took 20% of the top 1%'s money and gave it to the bottom 50%, that would be $10 trillion. That'd be that'd be giving them an extra 150% more wealth. And what would that do? That would solve the poverty problem. That would solve the Social Security crisis. That would alleviate the need for hundreds of billions of dollars of government services, because you're just simply increasing the wealth and the situation in life for all these people. That's how easy it is to fix everything. Just stop not taxing the richest people in the world. And again, this is not corporations. Corporations are also severely undertaxed. We're not even counting the corporations that are, you know, you talk about net worth, right? Apple, Google, Microsoft, Alphabet, these are all $3 trillion companies. NVIDIA, these are all $3 trillion companies. So that's $15 trillion right there, 5 companies. $15 trillion of net worth. And we don't tax them either. They pay an average of 12%. They don't pay anything. They don't even pay anything like what even rich people pay more than that. Even rich people pay 20% maybe. But rich corporations, oh no. You know, and why? Because, you know, and again, a lot of you guys, we are the people who own these corporations, right? We deduct things. We don't buy things, we lease them. We deduct the lease payments, we depreciate the assets, we move the money from here to there. We don't take the payment until a certain time of year when it's advantageous tax-wise, and so on. You know, there's like a million different ways that you can do it. We set up a new corporation, we have that corporation consult for this corporation, and we have this one trade out for that, and this one takes a loss and that one makes a profit, but then the profit is offset by the previous losses. You know, there's a ton of ways to do this, and we're defunding the IRS so they can't figure out what the hell we're doing anyway. That's what's happening. That's how the game is rigged. And who pays for it? Everybody else. Because when you look at the national debt, that is evenly distributed. It's everybody's debt. Therefore, it's not. And again, what was the number? Wait, there's a number here. Yeah. The top 1% is 2,756. The average person here is 2,750 times richer than the average person there. That's the issue. But when you look at the national debt, it's distributed evenly so that these people owe the same money as these people. Each individual person here, since they're a US citizen, owns the same amount of debt, owes the same amount of debt as each one of these people. So when these guys screw the system, don't pay their taxes, and causing the government to then accumulate debt, the debt is evenly distributed while the wealth is accumulated up here only. It's not fair at all, and it's been not fair at all since Reagan, which is getting on to 50 years. And that's what's wrong. And the thing is now, when you say we got to fix that, and I say something, you know, in my mind sensible, like, well, how about we just do a one-time transfer back to the bottom 50%? I'm not fixing the whole thing, but I'm just saying, why don't we do a transfer back and say, look, you guys, you have these guys have $165 million per person, not, oh, I'm sorry, per household, not per person, per household. So these households have $165 million. These households have $60,000. So I'm saying, how about we take, and these guys have more, so it'd be, this group would have 300,000, I'm sorry, they wouldn't have 300 million per household. But this combined group has $50 million, $50 trillion, sorry, $50 trillion. So I'm saying, why don't you take this $50 trillion, hit them with a $10 trillion one-time tax. That money gets transferred to these people, and that would be $14 trillion now that they would have, right? And that would be, instead of $60,000, they would all have $250,000 basically. All right. So now they've all got $250,000, and it's not fantastic, but it's enough to have retirement accounts, savings accounts, to be able to take care of a health emergency, so on and so forth. You know, and how you transfer it, you know, you can argue it and say, oh, you don't give it to them all at once or whatever, or we just fund Social Security, Medicare, and make sure they're taken care of and have more housing. And it's like, oh, that sounds like a government, right? Imagine that if you had Social Security and medical care was taken care of, or we had universal health care, and then we had a housing commission and an education department to make sure they were educated, and it would work like Europe where they didn't have to pay for it out of pocket. That's government. That's the thing we're dismantling. Why are we dismantling government? So that nobody is ever able to do what I'm proposing. That's why you're dismantling government. Because as you make the wealth inequality worse and worse and worse, you create a situation, which I pointed out somewhere today, you create a situation in which people are going to eventually rise up against you and say and demand that you give them 20%. They won't ask nicely at some point. They're going to say, hey, you've got $165 million in your household, and we have $60,000. That seems unfair. And if you don't agree that it's unfair, we will kill you and take your money, which is what the Russians did in 1917. And it works for a while. It feels really good for a few years, and then everybody the system resets and starts again, and all the money moves from one group to another. That's just the way the world is. The point of a government is to sort of mitigate that and make it so some of the money gets transferred back in. But we're not doing that at all. We haven't done it for years, and that's why it's so hard to fix, because we've let it get bad for 50 fucking years. We've let this happen forever. We never did anything about it. This is a recession. That's not, nobody did anything about it. It's a recession. And after the recession, we started throwing money at rich people, and it got much, much worse. Didn't get better for these guys. It got better for these guys. It got better for these guys. It got better for these guys. This is the top 10%. Got way better for them. The top 10% went from, let's say that line is 20 and this line is 60. So they had $40 billion, and now they have 50 to 160 is $110 billion. So they went from 40 to 110. These guys went from 20 to 45. Or 50, let's say 50, sorry. So they went up 30. So these guys got 150% more money. And these guys went from, what did we say, 40 to 110? Is that right? 40 to 110. So they got 70. Oh, no. They got 110 more. And 110 more is almost 300% more. So yeah, so these guys gained wealth. The top 10% after the recession gained wealth at double the pace of the bottom 50%. That's why things are so messed up. We let it happen, and now when people and this is where the idea of trying to take some of this back is why all of a sudden money started flying towards Donald Trump. And money started flying towards anybody who believed what he believes, which is that that the poor people in this country, and the poor people being the bottom 90% of this country, have no right to equality. They have no right to the benefits of this society, that they lost the economic battle and they need to shut up and go home. And as I said here, it's like the top 10%. The top 10% used to have half the wealth. Now they have 2/3 of the wealth. They're soon going to have 3/4 of the wealth. But when you have 3/4 of the wealth, you have to start hiring bodyguards to walk around with you because you're so much richer than the average person. You're going back to medieval times, right? Where rich people had guards walking with them wherever they went, because the poor people are able to hold a knife and you're walking right past them and they hate you. And you've taken everything and you're walking around with your freaking nice clothes and your gold and your servants and your cars and whatever crap, and this is, what do you think is going to happen in society? Of course, they're going to resent you. And that's a point people forget. And I made another point about the slavery. It's like, you think you won. And you know who thought they won? Was 160 years ago, the slave owners thought they won. They didn't allow the slaves to be educated. The slaves worked all day, had nothing, went home, had nothing. They had no money for entertainment. They had no money for anything fun. All they did is work and go home and have some food and whatever. And if they got sick, they just basically they put them in a ditch. And they got another one. They bought another one. And they made sure that the slaves couldn't vote and that their vote didn't count. They didn't educate them because they didn't want them getting any ideas about freedom and equality. And they had all the power, and the white people had all the courts, and they had the votes, and they had the money, and they had the police behind them, and they had every possible advantage to keep down the working class people, and they still lost, and they still got kicked out of it all by a war. So the GOP, who's in power right now, are drunk on it. And they think it'll last forever because they think there's tying up all the loose edges. The Southern slave owners had 200 years. It was 1860 basically that before Lincoln became president. So these guys had slaves for a couple of hundred years in the Americas, right? Columbus discovered the place in 1500, and in 1860, that's 300 years later. I don't know how long. Slaves started right away, pretty much in America. So they were, a good couple of hundred years of perfecting the art of owning human beings and downtreading on them, and making sure that they had absolutely no position in society whatsoever, and no rights and no nothing. That was an art form for a couple of hundred years when America was, quote, great. And even with all that, it didn't work. It didn't last. And every society across the board in all of human history, it doesn't last. There's a certain point where you take it too far and people can't feed their children and people are hungry, because what the French Revolution was about, right? The peasants were hungry. And they get, and when it's every day, and when you're sitting there staring at a window, and even if that window is a television set, and you're looking at these rich sons of bitches lording it over you, and the TV commercials are telling, I mean, in France it wasn't a TV commercial, but whatever, somebody's walking by in their fineries, but the commercials are telling you, here's the luxury life, blah, 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 and you know it's all bullshit. And you know you can't afford it, and you'll never afford it, and your children won't be able to afford it, and there's no hope at all. Then there's a certain turning point at which these people with all the money become the enemy, and the vast majority of people rise up against them. That's the path we're on. And we're not like a little ways on the path when you look at a chart like this and you see that the top 1%, the top 10% have a third of all the money that there is. This is the wealth. This isn't the earnings. The earnings are completely out of control too, but this is the actual wealth. And 1/3 of the money goes to 10% of the people. And let's look at it like it's let's look at it like it's actually food. So talk about the share. So you have 100 people. That's not even one person. Well, this is a 1%. These two people who are 1%. So you have 100 people, and one guy gets 30 apples. That's what this is. One guy gets 30 apples. These 9 guys get 36 apples. These 40 guys get 30 apples. So there's a problem here already. These guys are happy. They can't imagine what's wrong with the system. They got 30 apples. These 9 guys, they got 36 apples. So they've got 30 apples each. These 9 guys have 36 apples between them. So they've got 4 apples each. They don't see a problem with the system. Sure, there's some guys who have more apples than them, but that's okay, because 4 apples is more than they need. These guys have 30 apples for 40 people. They have less than 1 apple each, but they need an apple a day to be happy, let's say. And they're not exactly happy, but they're not starving. So they're content to be in the system that keeps them with almost an apple a day. Maybe not quite, they're always a little bit behind. And the trick is to just die before you're so far behind that you can't eat anymore. That's it. You're just eating a little bit too little every day. And this is what living paycheck to paycheck is. You got just enough to get through the week. You're a little behind. You might accumulate a little debt, but you're surviving. You're working your full work week, you're doing whatever, and you're barely surviving, but you are surviving, and that's your life, you're surviving. But these guys, here's 50 people who get 2.5 apples. So, where's a calculator? Need a calculator for this. Oh, I'm not going to get one. Well, there it is. All right, so clear. So 2.5 apples divided by 50 people is, that would be 1/10 of an apple. So it's half of 1/10 of an apple. That's how much they get when you need an apple a day to survive. And the thing is, they're getting a half of a tenth of an apple, while these guys, don't forget, this is 1%. These guys have 30 apples. They're walking by with a bushel, a basket filled to the brim with apples. They're falling out of the basket. And they live right next to these people. These people are cleaning your house. These people are washing your car. These people are serving you food. They're everywhere. And you're walking around with a basket of apples filled to the brim, and if an apple falls out, you would rather call the police than give it to one of these people. That's our society right now. That's what we're doing. And you can pretend that you're this and that and charity and blah, 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 and blah, blah, blah. This is the structure of our society. We have allowed this to happen. We haven't just allowed it to happen. We just voted in a guy who's going to make it better. We're going to make our basket bigger. We're going to kick these. You know what the problem is? There's a lot of these people we could kick out of the country. Then they'll stop staring at us like they want something. That's how we're going to fix it. We're going to make less of them. That was Hitler's idea, right? We're going to make less of the underclass. We're going to eliminate the undesirables. Because why are they breathing our air? Why are they living on our land? Why are they next to us? We don't like them. We don't want them. That's the next stage of this attack on the poor. We've already taken everything from them. This is what they got left. 0.05. That's what they have left. We have 30 and they have 0.05. And we would die if we ate all our apples. And they have none. And they look at you and they look at, you know, whether, again, this goes back to why do you not educate? Why did they not educate the slaves? Because you don't want the slaves to be able to do this math. If you understand the math and you see what's going on, then it's very easy for somebody to rise up and make a speech and everybody's like, oh, okay, this is bad. We need to overthrow these people. So you don't educate them. You don't allow them to communicate. You keep them working so hard they're exhausted and can't organize themselves. You give them no rights so they can't protest or exercise the free speech. And then we're doing the Roman thing, the bread and circus. What's bread and circus? Bread and circus is frickin' the internet. Is these apps and games and this and that and there, you know, whatever social media, anything to distract them. You know, I mean, this is insane. How did we become this? And you think there's not going to be blowback? We're killing these people. There's 165 million people in this group, 66 million families, and we're killing them. And I cannot even begin to describe. I live in Florida. I talk to Social Security people all day long. I cannot begin to describe how harsh of a reaction we're going to get if we start cutting. Forget not giving people enough of an increase. You start cutting people's Social Security and giving them less money to live on than they had last year. And that it won't even be in a vacuum though, because what's going to happen is people won't be able to afford the apartments they have. They won't be able to afford the homes they have. The economy will collapse down here too. The economy is based on these people getting the money that they were promised in Social Security. You stop giving them that money, there's no alternatives. That money's not going to come from nowhere. There's a real sickness to what we're doing. We are sowing the seeds of our destruction very quickly, folks. Anyway, all right, so that's good. So that's fun. All right. All right, so where were we? All right, so now back to making money. Now let's all make money because we're rich. We need to be richer. So I put out a top trade alert. This came out of the chat room the other day, whatever day that was. The 24th was, I guess, Monday. And as I said, we've been waiting very patiently. We cashed out earlier on before the big dip. We cashed out, and now we have we're well hedged, so we have a little more fear of missing out than oh, where's the summary? Ugh. Warren made a good summary. I think I should go to this different page. Sorry. So where is he? Da, 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 da. Should be like the last comment of the day. There it is. Okay. So I just want to give you an idea of where we ended up. So what did we do? We added back. So we cut back a lot of trades in our portfolios. And butterfly or world tone strategy. So these are the new trades we exercised in our portfolios. In the short-term portfolio, we sold puts, and that's 20,000, 22,000, and 10,000 basically. So it's less than I thought. It was 50,000 something dollars. So we sold puts in Lennar, Micron, and VSC. In the income portfolio, we added Ozark, Foot Locker, Whirlpool, and Best Buy. This is almost exactly what we ended up putting in the Money Talk portfolio. In the Butterfly portfolio, we added Disney and Levi because we like them, but we don't think they're really going to jump back up too fast. That makes them good for the Butterfly portfolio. And in the $700 a month portfolio, we added Macy's, Foot Locker, VSC, and Levi. And notice that's very much the same as the income because those are both conservative portfolios, and that's what we did with them. So I thought that was a good summary because you can see like portfolio by portfolio. So it's not like we're making this giant thing. Yes, we added 15 trades, but the 15 trades we added are carefully deployed. So we only added a couple of trades to each portfolio. So I said here, we've been waiting patiently for a sell-off and more patiently for a bounce. And we're getting how's the market doing, by the way? Ooh, yes, see what happened with oil? So now we got back to our goal basically. So I'm very happy about that. And so now what you do is when you're hitting your goal, and I'm sorry I missed it before, but when you're hitting your goal, oh, not 10. How do I lower that? Oh, shoot. There it is. Right? I had that problem before. I accidentally did something. Shingle. Okay. Whoa. Okay. So now what I'm going to do is just lower. Whoop. What's that? Oh, I can't do 10. Oh my God. Damn it. See, that's the problem. It's stuck on 10. And if you make a mistake, just do the opposite and get rid of it. It's no big deal. So where was I? I was buying. Buy. Single. Not 10. Son of a bitch. I'm really killing my profits here by doing that. Anyway, I'm trying to buy. What? Ah, Yeah, there we go. Thank you. Holy crap. So I want to, oh, I'm over. I'm on the wrong side. I don't want to be bullish. It's working out. It's accidentally working out. All right, I screwed this up, so I'm going to get out. 3. I'm not, because I don't want to be bullish. All right. Nah. All right, so up 1,300, done. End of story. See, it's 39 by 39 now because I screwed up. So we were up 1,600. I just lost $250 because I did the wrong thing. Anyway, so fine. So it came down. We hit the point which I missed, but we hit the point where we planned to hit and planned to get out. Because I said this is where we're going to take a not greedy exit, and it worked. End of story. All right. Ideally, I'd like to keep it. I would like to keep a couple short into the close, but I'm not going to watch it, so I don't want to do it now. Why the hell are we here? Now I've completely forgotten what we were doing. Oh, we were going to look at the market. That's all. I just want to take a quick look and see if we were bouncing. So yeah, this is holding up. So the short story was we expected to have a bounce. So we came down. We expected to have a bounce, just in basically exactly what oil just did. It's the same story. We get to a certain point, we expect to have a bounce, and that certain point was minus 10% pretty much. And from minus 10%, we expect to get a at least 2 and probably 4% correction. You know, as a 4% bounce is what a strong bounce is. So from 10%, you get a 2% weak bounce and a 4% strong bounce. And now we expect to go back to making that W, but we were worried that we might actually, if it kept going up and we got a V recovery, we'd be screwed. And Trump could have said there will be no tariffs, we're delaying the tariffs, blah, blah, blah. We were worried about that. So that being the case, we begin accumulating some stocks back. But we're bringing stocks back that we think are well sold off. So I said, Lennar. So we sold some Lennar puts. We picked up a Macy's spread. We picked up another Macy's spread. So for the income portfolio, for the 700 portfolio, for the short-term portfolio, you see how this we're spreading around. In the long-term portfolio, we did Micron. And what did we do? All we did was we got out of Micron, and it went down, and we said, oh, you know what? That's holding up pretty well. Let's just sell some puts. All we're doing is selling some puts in the short-term portfolio because this held up pretty damn well in the sell-off, and we feel comfortable owning Micron for $100 minus the $22.75 we're selling it for, which is $77.25, right? So that's all we're doing. We're promising to buy Micron for $77.25. Where is $77.25? It's way the frick down here. It has been rock solid at 85 for more than a year, and we're saying we'll buy it at 77, 75 or whatever, 77.25. We're buying it down here if it gets down there, and all we're buying is 1,000, and we're happy to buy way more than that if it goes lower. And then on we put back in the long, and don't forget we're putting them back. We had them in there, we cashed out, now we're putting them back at lower prices. Here's Ozark Bank, which I just put in the Money Talk portfolio as well. We put it in the income portfolio. And again, how did it perform in the sell-off? How did it perform in the market pulled back 10%? It did pretty well. It went from 52 to 44. It's holding up here nicely on this rising channel, and it's a great bank. So we like it. We need banks. That's another factor is we need banks. We need more banks. Disney, I said we usually have it in the butterfly portfolio. Why not? We don't care if it goes up or down. What we care about is whether we can sell puts and calls against it, and we can. So we're happy. It brings in fact, we sold 19% of our position in the first 88 days. That's like getting a 19% dividend every 3 months. That's what this play is. We don't care whether we obviously we would like it to make money. We would like our position to do well, but that's not really important when we have 2 years to collect 19% a quarter. Target, we put it back in the long-term portfolio. And again, what did we watch? We said, well, here's a big sell-off in the S&P. They had bad earnings here and nobody cared. Now they had good earnings and everybody acts like they were bad. It was their guidance that was bad. But even with this guidance, look at the buyers. Look at this. Look at these buyers. I mean, yeah, some of that was us. look at these buyers coming in and supporting them at 105. So we're making a value call here and saying we think this is. And by the way, look at this RSI channel. Look how low that is. Look what happens when the RSI is low. Here, 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 here. That's what RSI is, relative strength indicator. This is when you can, this is telling you you've reached a point where the stock is extremely oversold. It's very hard to go lower than this on the RSI. That's why it's always a blue channel here. Very, very rare that RSI gets below here, and we are below. So I'm treating this like a bargain we're not likely to see again. And we sold 15 June 110 puts, because that's another thing when you're selling puts. You don't have to sell the puts at the line you're at. You've got to make a value call. My value call is that this is stupid and easily 110 works. And if we sell the 110 puts for 9, we're really committing to buying at 100. So am I willing to buy Target at 101? Yeah, absolutely. So are these guys. So is this huge volume spike worth of people. They were willing to buy it too. They voted with their money. Here's Foot Locker again. We added that. We had in the 700 a month portfolio, in the income portfolio, we added them as well. Same story. Foot Locker was here. Now it's here. And as I said, in fact, this is one of the ones we added for Money Talk. The thing about Foot Locker, and again, good earnings. Bad earnings, started going down, had good earnings, not so great guidance, drifting along, but there's an outside factor, and the outside factor is that Nike was a bomb. And Nike was a bomb because 5 years ago, in 2020, they pulled out of Foot Locker and other retailers, and they concentrated on their own stores and direct sales. And that was a fatal mistake for the company that sent it on a death spiral. And we wrote a whole, there's a whole special article written by Hunter on what went wrong at Nike. If you look on the main page, you'll find it under my post. So that's detailed, the saga of what went wrong at Nike. But the bottom line is, when you think about that tangentially, they've got to get back into these retail stores. That's what the new CEO is doing. He wants to put them back in the retail stores. To get back in the retail stores, Nike is now in a poor bargaining position. They used to be in a great bargaining position because they were Nike. Now they're in a terrible bargaining position. They're going back to the retail stores. So Foot Locker is going to get better margins on Nike than they used to get, and they're going to have Nikes, which they haven't had for a long time, and all the inner city kids who want to still buy Nike shoes are going to come to Foot Locker and buy Nikes. So this is a great time to get into Foot Locker. Here's VFC. And we did that in 700 a month portfolio. We also put it in the short-term portfolio. And then there's Whirlpool, and Whirlpool, we pulled out of it. But since we pulled out of it, new information came to light. And that new information was, I was talking to Bodie, and he was going over things. We were talking about what stocks from that we had pulled. Out of all the stocks we pulled, which one should we be putting back? And he said, what about Whirlpool, which was not on my list? And he said, I like Whirlpool. And I said, I don't like Whirlpool because of the tariffs and things and their, their supply chain concerns and so on and so forth. And he said, yeah, but Whirlpool only imports 40% of their stuff. 60% of their sales are domestic made things or things where their supply chains are very distributed, small items like blenders, Whirlpool blenders. You go to Best Buy and you look for, if you start thinking about it, they've got blenders, they've got convection ovens and what's that things, air fryers and toasters and things like that. They make a lot of small appliances. That's more of their sales than washers and dryers. And I had no idea. I really don't think it was anything but a washer and dryer company. So we looked at the numbers. I looked at the thing. I said, oh, you know what? You got a fantastic point. It's like, that makes sense. So we think this is a great opportunity. And look at Whirlpool. We got out. They took this hit over here early in the year, right? Because the tariff thing, that's what sent them off the edge. But when the market crashed, they really only went down from 100 to 90. And obviously people started buying back in at 90 and they're back at 95. So we're like, yeah, why not? Let's get back in. We cashed out at a higher number and now we're getting back in. So we've got plenty of buffer on the situation. And here's Best Buy. It's an LTP play. We're getting back into those guys because, again, how are they really? They're not really impacted by the import stuff. Maybe there will be a little bit less sales, but, Best Buy is still going to sell stuff. The price of the stuff isn't really important. They'll probably maintain their margins. I don't think it's going to really heavily import them. Levi's is I think a great one. It's much too cheap down here. And again, it's the same thing. We got out, it went down, it found a nice bottom, and we're comfortable here. And this is cheaper than we got out. So we just saved money. And those are our stocks. So Butterfly, 700, long-term portfolio, short-term, 700, income, 700. Put a lot of things in 700-month portfolio. We really had a chance. Long-term portfolio, Butterfly portfolio. So it's 15 trades, but it's only a few trades in each portfolio. It's not like we went insane and doubled the size of our portfolios. We bought a few new stocks because we want to participate if there's any kind of good upside. Whether that holds up, whether we manage to pull out of the tailspin the market's been in, that remains to be seen, and we were not going to know until we find out exactly what these tariffs are and what they're going to mean. But as I said, I think we're going to do a W, and you're going to see a W form, a pattern here. That means we might retest these lows. If we form a W that doesn't retest the lows, that's very bullish. If we form a W that retests the lows, we're really not going to know until we see the next leg. So look, here's a W that actually breaks the lows, but then a nice leg up. Here's a, well, that's a weird W, but here's an ugly W. Still a W though, right? And we get right back to the same high, fail again, but now look at this W is bullish because it goes W, higher low, and then we consolidate and move up. And then we have a weird W that breaks down, and then we go back up, and there's a little W thing, and it goes up again. And because it had a strong second leg. That's what you want to look at. Here's another W, strong second leg. All right, but then that was December. Things are stupidly high at that point. And you also have, you don't in a vacuum look at this stuff. You have to look at the actual valuations and things and make sure you're not being crazy. But anyway, so here, and then what happened though? Then you go into a W, which breaks down. You can see it breaking down right here. It didn't make that V. It had a failure at the strong bounce line and it went lower. Then it goes back up, and now we're coming back down and making another W. And hopefully, depending on where this leg finishes up here, the down leg, we'll see what kind of pattern we get over here going this way. But I think it's going to go down and drift and fizzle along this line. I don't think with the tariffs, I don't see what's going to be the catalyst unless Q1 earnings are better than expected. I super doubt that's going to happen. And then Q2 earnings are going to be impacted by the tariffs. So that's not very encouraging. And then what's going to happen in the second half of the year? Will the Fed, and again, will the Fed lower rates? It looks like the Fed's very unlikely to lower rates because the tariffs are going to be inflationary. So where's your catalyst? Where are the corporate earnings? Are corporate earnings going to improve? Is the macro environment going to improve? No. So we're probably going to fizzle and fade. And again, we're looking at the Dow and not the S&P, which is stupid. So we're going to fizzle and fade around here, around where we were last year. Things are not better than last year in the terrible Biden economy, right? Things are not better than they were last year. So we're probably going to end up around where we were last year. And there's wild cards because you don't know how much AI is going to improve things for corporations. We have an economy that is very, very focused on the Magnificent Seven. They're like I said, they are $15–20 trillion worth of the S&P 500, which is only a $50 trillion index. They're 40% of the frickin' S&P 500. That's insane. 7 companies. So it's not about whether the entire S&P 500 is able to deal with the tariffs and able to maintain margins. It's what these 7, it's what Google and Apple and Facebook and well, forget Tesla and Amazon and whoever. It's about what those guys do. And Apple, can they beat the odds? Can they beat the tariffs and do stuff? Yeah, of course they can, because Tim Cook's a supply chain genius. And they've known about this for ages. Alphabet, they don't give a shit about tariffs. They don't sell stuff, they sell knowledge. They just put out a new version of Gemini. Their Notebook LM product is the greatest AI product that's been done yet, but it's not easy to use, so nobody talks about it, but it's freaking amazing. Oh, I gotta remember to show that next week. All right, I gotta show you what Notebook LM is. It's amazing. But it's hard to use. It requires actual thinking, and that's not, so it's actually so not popular, I couldn't believe it. I looked on a thing that was like, how many users does each thing have? And ChatGPT has like 2 billion users, and then it goes down to Bing has or whatever is Copilot. So Bing has this. Then I looked at Anthropic. Anthropic has 10 million users, something crazy like that, some stupid low number. And then I looked at Notebook, and Notebook's got like 1 million users. And I'm like, I cannot believe this. But I thought about it, and I'm like, yeah, it has 1 million users because it's hard to use. It's for geeks. It's for people who are actually into this sort of stuff. But if you know how to use it, it's the best one. It's just unbelievable what it can do. Well, I'll say that it is the best one if you know how to use it. But the problem is it's not at all intuitive. They have no instructions, and you have to be very, very well versed in AI to put it to good use. Otherwise, it just seems like a mishmash mess. They're putting out a better version of it, and it's amazing. Also, ChatGPT's new version is a big, big step up, like real improvements. So what a company's going to do with it? So if it was my company, obviously you guys see it when I'm working on it. I can do all sorts of great things with it, increase productivity, and do all kinds of fun stuff. So anybody can do it, but how many people actually will do it, and how will it impact their bottom lines? That remains to be seen. But we're very heavily geared towards the performance of these 7 companies that are basically in the AI space. Even Tesla is technically in the AI space. They sell a car, but the big wild card for Tesla is, are they going to be selling self-driving cars? And that is more of a software issue than a hardware issue at this point. But although now there's the psychological factor of Elon Musk and all that too. So that's where we are. It's like a lot of wild cards that just need to resolve themselves. So we added stocks to make sure we weren't going to miss out. And we will now see, now the Nasdaq's down almost 400 points. So we'll see what kind of pullback we get. And don't forget, we got out of those tech stocks. We don't have them. We have a couple, but not, we aren't really invested in those companies because we expected the Magnificent Seven to do poorly because they were overpriced. NAGS. That's them. So, we expected this. We were surprised that it ever got this high. And it doesn't say so, but they're still trading at more or less 30 times earnings as a group. And so they need to go down another 10%. That'll be 27 times earnings. So 47 minus almost 48. So 48 minus 4 is about 44. So they're pretty much where they should be. They should be down around here. Even with the growth, even with all the good stuff, they should be down around here. The question is, what are their Q1 earnings going to be? What is their guidance going to be? And what's their cash situation? How much money are they spending? These guys are spending $300 billion, $350 billion on AI and AI infrastructure. Just these companies, just these 7 guys are spending $50 billion each, which is way more, the best ones, Apple and Microsoft, they earn $100 billion a year. Amazon doesn't make $100 billion a year. Google doesn't make $100 billion a year. This is a significant amount of these companies' entire earnings. And they put it all into a huge bet on AI. Will it pay off? And if it doesn't pay off, God help us all. And we don't know any of that right now. So we have to sit back and try to be balanced. And yes, okay, yes. When I see Ozark trading for 7 times earnings, when I see Target trading for 10 times earnings, and I close my eyes and say, will my grandchildren ask me what Target is? Okay, will my grandchildren ask me what Foot Locker is? Will they have no idea that there was a store named Foot Locker? The way Blockbuster. My grandchildren will say, what the hell is a Blockbuster? You got to explain it to them. I don't expect to have to explain what Best Buy is. I don't expect to have to explain what Levi's are. I don't expect to have to explain that Whirlpool makes appliances. Most of these things are, Disney. I seriously don't think I'm going to have to explain Disney to them. Macy's. Micron makes chips. They're not going to know that, but Micron makes chips. Lennar makes homes. I think these companies will survive. And if they're going to survive and they're trading at 10 times earnings, I'm interested in owning them for the long term. They'll work it out. You've got to look at something and do the valuation and say, oh, you know what? What does it mean if they have 10 times earnings? If they're trading 10 times earnings, it means if I give them $10, next year they're going to make $1. That's what 10 times earnings is. I'm paying 10 times what they make. So I'm getting 10% back on my dollar. Do I have a better place to put my dollar that's going to make me 10%? Not treasuries, that's 4%, 5%. Not housing, that's 4%, 5% also the growth of housing. Not to mention, in the housing market, you're getting taxed and things like that. This is a builder, not housing, so it's a different overall. But to invest in housing and to invest in bonds, I'm not getting the money from the bonds. I'm not getting the money from the interest rates. I'm not getting it in the bank. At the moment, I'm getting it from commodities. There's an alternative that might pay me more, but do I trust that? Am I sure that I'm going to make 10% every year for the next 3 years on gold, or will Target pay me that much money? And then you have to take into account that Target usually trades at 17 times earnings, not 10 times earnings. Therefore, Target can also go up 70% very easily if things normalize over time. So if I'm getting 10% a year plus they start moving back towards their 70% improvement, I really have literally the whole rest of the decade to make 5 years times 10% is 50% plus the 70% growth back to their normal valuation. I can make 20% a year easily on target. And I feel it's a solid foundation and worthy of my investment dollars. Therefore, that's where I want to put my money. That's how these decisions are based. You're always making a choice. You've always got to look at the alternatives, and you've always got to think about where the money's going, how the macro environment's shaping up. Macy's is a real estate play as much as it is a retail play, but people still need to go to stores and buy things. People still need to live in homes, and we have a tremendous housing shortage. So whatever the price of the homes is, Lennar's still going to build them. This is something people don't understand when they do housing. Chips, Micron, please. Okay, they don't make the NVIDIA kind of chips, but they make the chips that go into the NVIDIA chips. So we like that. On Ozark, these are basic plays that you want to get involved in. Disney is obviously Disney. Target is Target. Again, it's a retailer. Foot Locker, another retailer. Basic stuff people are going to be using. And I don't mean now. I don't mean next quarter. I mean for 10 years. It's not going anywhere. That's the kind of trades you want to get into when you're worried you could be heading into some kind of recession. And if they get a little cheaper, so be it. But what I'm saying here is that these are like no-brainer stocks to own if the market does recover. If it doesn't recover, that's what we've been playing for. We're so overhedged at the moment for a 20% drop. We thought the drop that just happened would be much, much worse, and we are well prepared for it to be much, much worse. We won't know more until next week. That means next Wednesday's webinar is going to be very exciting because that's tariff day. So we'll see what happens. All right. Let me see if there's a question before I close out. SK says, don't have lots of LTP positions in my portfolio. When should I add any of it to my portfolio? Well, like I said, we just added a few, and we're being very careful about it because until next week, we're not going to have any idea. Next week, we'll have a better idea. But you want to bargain shop, and you want to pick up things that are very good values that you believe in. Don't buy stuff you don't believe in. Buy stuff you do believe in, and build your portfolio around that, around solid value stocks. All right. Well, thank you everybody for coming. I appreciate it. And tariff day next week. We'll see what happens. Take care.